Calculating RMDs, required minimum distributions. So the good news, in most cases, you're not going to actually have to calculate the RMD yourself. That's because most of the companies you have your money with, they're going to send you a statement, probably multiple statements throughout the years and notices telling you you have to take out this much for this time period, by such and such date, which is usually December 31st. But if you did have to calculate it, how would you do that? Well, the way it works is the IRS takes your account balance on December 31st of the prior year and divides that by a number on the IRS. It's called the Uniform Lifetime Table. There's a couple tables, but the IRS table, they use it to calculate your RMD. So you pick your age, you pick your account value on December 31st of your prior year, and you divide them into each other to get how much you need to take out per year that year. And that's the RMD for that particular account. Now, again, you're probably not going to have to calculate this because most of them will do it for you, but here's something to remember. Let's say you have $400,000 worth of pre-tax retirement money. And only pre-tax retirement money has to have RMDs. So after-tax retirement money, which includes Roth type stuff, Roth IRAs, Roth 401ks, they don't have RMDs. You're not going after you're 59 and a half, there's really no chance of you getting taxed on that money. So the government kind of doesn't care when you take it out. So you don't have to take it out. You can keep it until you die. You don't have to take it out. But your pre-tax money has never been taxed before. So in these scenarios, once you get to 70 and a half, in most cases, there's a few exceptions, but you're going to have to start taking required minimum distributions. But let's say you have $400,000 worth of pre-tax money, and that's coming from about four or five different accounts. Well, what you can do is you can say, hey, this notice says I got to take this notice says I got to do this and this. You can add them all together. So let's say you got to take out, it's $400,000. Let's say you got to take about $15,000 collectively out of all of those accounts. You can actually take the whole $15,000 out of just one of those accounts. So you can add up all those notices or add up all the numbers and do the calculation yourself and take the RMD from just one of those accounts, whichever one you think is maybe the most advantageous to take from. There are some that you may have investments that you really like and maybe you don't want to sell. It's possible that you may have annuities that are pre-tax that you don't want to kind of dip into yet, or you don't want to maybe start the income on them yet. So strategically, it could make sense not to pull individually from each account that has an RMD notice. It might make sense to kind of combine some of them and pull them from one of them that's a bit more, let's call it dip friendly. But again, in most cases, you're not going to have to calculate the RMD yourself. If you did, the text kind of has the table broken out there, and you can kind of review that and what the calculation would be. But in most cases, you're not going to have to worry about that. Just make sure you do take it, because if you don't take it by the end of the year, you got a 50% penalty. So you certainly don't want to miss it. But I hope that helps, and I look forward to sharing more with you as we close out retirement withdrawals.